Ladies and gentlemen, good morning. Today I'm going to present a few slides on the macroeconomic implications of Brexit for the UK economy, the world economy, and Greece. These slides are from a more extended presentation we, Eurobank Economic Research, have prepared on the occasion of today's events, and we're going to be publishing in a few days. And I would like to start by saying that the activation of Article 50 sets off a two-year countdown for A, reaching a withdrawal agreement, and B, reaching a new association agreement between the UK and the European Union. If there is a failure to reach an agreement over the period of 2 years, and if there is no transitory deal, then the UK will risk losing access to the single market. And this is very important because the single market of the European Union is something more than a simple free trade agreement or a customs union. The single market is based on the so-called four freedoms: the freedom of the movement of goods, services, capital, and people across borders. In addition to that, services are very important for the UK economy. Services account for around 4/5 of UK's GDP, around 2/5 of UK's exports, and apparently maintaining access to the single market in financial services is very important. It's the so-called passporting right, and the European passport. And actually, the European passport allows UK firms and corporations to operate in other EU 27 countries by, for instance, establishing branches and not having to establish subsidiaries, which is a much more, let's say, expensive and complicated way of operation, as it requires independent management and capital structures. So that's the framework. And I would like to look at some slides. The first slide presents a history of the European Union. It starts with the establishment of the European Steel and Coal Community in 1951, the establishment of the European Economic Community in 1957, the joining of the UK to the European Economic Community in 1973, the first referendum in UK on EEC membership, where the yes vote basically won with 67%, the establishment of the Single European Act, of course the Maastricht Treaty in 1992, where the UK basically was granted a number of opt-outs. So the UK has opt-out of the obligation of other European Union countries to basically move towards a closer European Union, and the obligation to ultimately introduce the single currency, the euro. And of course, it has opted out from the Schengen free border treaty. Then, in 2004, eight Eastern European countries joined the European Union. 2009, the Lisbon Treaty, and 2013, Prime Minister Cameron promised to basically renegotiate the UK's EU membership terms and run a referendum if his party won the May 2015 elections. And of course, June 2016, when basically the Brexit referendum delivered a broadly unexpected outcome. Of course, the Brexit calls gain momentum partly because of the, let's say, the severity of the euro area debt crisis. And you may see on this slide the front page of Daily Express in November 2010, when the newspaper was the first mainstream national UK newspaper to support the case of Brexit. And of course, the European Union has basically activated Article 50, and there is a very long and complicated process to basically try to reach a compromise, a withdrawal agreement, and also, as I said earlier, reach a new association agreement with the European Union. It is important, I think, to note that basically abiding by the free movement of people, let's say, principle of the single market and paying contributions to the EU budget are the prices to pay for access to the single market. So if you look at existing agreements, existing association agreements with the EU, you can see that there is basically a trade-off between independence to set your own laws, your own policies and regulations, and access to basically the single market. If you look at the two extremes, EU membership implies very limited ability to basically ignore European Union rules, implies contribution to the European Union budget, implies no flexibility to determine your own national immigration policy, and basically gives you the ability to influence EU rules by having voting rights to influencing these rules, provides you access to the single market, which is very important for the UK, and of course providing the so-called EU passport. On the other side of the potential, let's say, outcomes is the default to WTO rules. This is an outcome that I think, as it was mentioned by the previous speakers, is considered to be the less desirable outcome in terms of the macroeconomic implications of Brexit. And of course, the default to WTO rules provides a country the ability to basically ignore EU rules, have no contributions to the EU budget, run its own independent immigration policy, and of course, having no ability to influence EU rules and laws and regulations, provides no access to the single market, and provides no, let's say, access to the services market. It seems that the UK will aim to basically reach a compromise with the European Union, a so-called bespoke agreement, which terms, of course, remain to be seen. A few slides about the potential transmission mechanisms of the Brexit process to the UK economy and the rest of the world. It is true that initial expectations for a slowdown in the UK economy after the Brexit referendum proved overly pessimistic. Basically, the UK economy performed impressively well during the second half of 2016. As you may see on the chart on the left-hand side, and you look at these bars, you will see that, for instance, UK GDP grew by 0.5% on a quarter-on-quarter seasonally adjusted basis in the third quarter of 2016, and by 0.7% in the last quarter of 2016. In my opinion, some of the, let's say, shock absorbers included a swift policy response by Bank of England. Bank of England introduced additional quantitative easing and cut its policy rate by 25 basis points. Of course, since November 2016, monetary policy of Bank of England has shifted towards a more neutral, let's say, stance. The postponement of Article 50 activation to early 2017 reduced political uncertainty after the previous Prime Minister was replaced by Theresa May. And of course, the easing in monetary and financial conditions we've seen during the second half of 2016, especially the depreciation, the sliding of the sterling. However, the immediate period, however, the Brexit impact may become more evident following the activation of Article 50, as uncertainty about the final outcome of negotiation increases in the period ahead. And we do see some early, let's say, worrying signals. If you look, for instance, at the PMI manufacturing index of the UK, you may see that most recently we've seen an uptick, although the index remains above the threshold of 50, which separates expansionary and contractionary conditions in the UK manufacturing sector. We've seen a sliding of consumer sentiment, and of course an uptick in inflation due to the pound devaluation, the sterling devaluation, which is a risk for real wages. As regards the longer-term impact of Brexit on the UK economy, there have been a number of studies recently, over the last several years, trying to basically predict the macroeconomic impact of Brexit on the UK economy and, of course, the global economy. Most of these studies predict a permanent reduction in the level of UK output. There is no consensus in the literature as regards the medium and long-term potential growth rate of the economy. We're talking about the level of nominal GDP. And there are a few studies, of course. For instance, a more recent study by Minford, which was published in 2016, which predicts actually a gain from Brexit, a long-term impact of 4 percentage points of GDP. This particular study assumes that there is not going to be a significant trade disruption due to Brexit, that the UK will be in a position to unilateral lower tariffs, which is going to be a good development for UK consumers and businesses, and of course that UK will implement very aggressive deregulation. But there is, I think, let's say, a consensus that Brexit will be harmful for the UK economy. A first channel of transmission of the Brexit, let's say, impact is the trade balance. It's external trade. And the European Union is a very important trading partner for Brexit. Total UK exports to the rest of the European Union account for around 13% of UK GDP, whereas exports from the rest of the European Union to the UK account for around 3% of EU 27 GDP. The first graph on the top side shows the evolution of gross capital formation, which is investment, and the evolution of gross national savings. The difference between these two lines is the current account balance, the current account deficit in the case of UK. And UK runs a very significant current account deficit with the rest of the world and with the rest of the European Union. In order to sustain this kind of deficits, UK needs to attract investment, needs to attract FDI, which is a very important source of financing the current account deficit, and or other type of capital. And if there is, let's say, a hard Brexit, then there is a risk of a slowdown in domestic demand, mainly investments, an increase of national savings in order to basically compensate and finance the discrepancy between gross capital formation and gross national savings, and or a permanent depreciation of the sterling in order to restore external equilibrium. In terms of the financial sector, as already mentioned, passporting is very important. Actually, if you look at the total assets of the UK financial system, the ratio of total assets to GDP is currently 830% of GDP. Actually, this is a figure based on 2014 data, which is very important. The UK financial sector has grown quite significantly in recent years, and exports of financial services as a percentage of GDP are way above the rest of the European 27 countries. In terms of FDI, which is another potential transitional mechanism of the Brexit, let's say, negotiations and the Brexit impact, the Brexit outcome, relates to FDI. Britain has been a global magnet of FDI. It has attracted huge volumes of FDI. Around 50% of intra-European FDI goes to the United Kingdom. Of course, a part of this development relates to EU membership, and a part relates to very raw regulatory, let's say, burdens in the UK, and of course, a very strong institutional and regulatory framework, as it was mentioned by the previous speakers. So, any agreement being reached in the period ahead should not basically instigate a slowdown in FDI, which is very important for the UK economy. Immigration is another potential area that could affect growth going forward. There have been a number of studies recently claiming that immigration to the UK, especially immigration from the rest of the European Union, has been good, has been positive not only for growth and UK's GDP, but also for productivity. Immigration allows UK-based firms to match skills with jobs, allows a long-term boost in productivity levels, and of course, immigration is another major issue of negotiations with the rest of the European Union. There have been some claims that UK could gain from promoting aggressive deregulation. There have been some doubts about the potential for additional gains because the UK is currently one of the least regulated markets in terms of regulation pertaining to both goods and exports and regulation pertaining to labor laws, for instance. So UK has been one of the least regulated markets and countries in the OECD. There is evidence that EU membership has not constrained regulation. Actually, if you look at the first chart, for instance, bar chart, you may see that Netherlands is leading the rest of the pack of EU development countries in terms of deregulation, and Netherlands is a member of the European Union and a member of the Eurozone. Of course, a potential positive for leaving the European Union is that UK would save in terms of potential contributions or current contributions to the EU budget. If you look at these graphs, you may see that the UK is a net contributor to the EU budget because the size of its economy is relatively large and its agricultural sector is very small. UK is also a recipient of EU structural funding. More than 95% of EU structural funding supports research and development, scientific research, supports agriculture and regional development. So UK would save from not having to contribute to the EU budget, but again, contributions to the EU budget are the price to pay for maintaining some degree of access to the single market. So this is an open issue. Overall, I think that at the end, UK will save some funding, some contributions to the EU budget, but there is uncertainty as to the actual outcome as regards this particular issues. And recent research has shown that other countries in the euro area will also suffer a negative effect of Brexit. There are certain countries in the euro area that have, let's say, strong trade and investment ties with the UK. It seems that Ireland, Malta, Cyprus, the Netherlands, Belgium are 5 of the EU countries that are likely to be more affected by Brexit. And a few slides about Greece. As it was mentioned earlier, Greece runs an overall current account surplus with the UK. It runs a deficit in goods, in the bilateral trade of merchandise exports and imports, and it runs a surplus external balance as regards services, with tourism and shipping playing a major role. Overall, the net balance in 2016 was 1.4% of GDP. Of course, UK is a very important trading partner in terms of services, especially tourism, and apparently a hard Brexit, which is an outcome that will hopefully be avoided, would have an impact on the Greek economy via various channels. The most obvious one is tourism and shipping. And this is a rather scary graph for the Greek economy. And this is kind of unrelated to today's presentation, but I think is a graph that shows how much Greece needs to basically needs services exports to the UK and to markets like the UK, because if you look, for instance, at the evolution of Greece's GDP, and if you compare the evolution of Greece's GDP with, the euro area GDP and the Cypriot GDP, all indices are normalized at 100 in 2007. You may see this big decline. And even if official sector forecasts for the period ahead materialize for a growth rate of 2.7% this year and around 3% next year, Greece will continue to basically lag the rest of the pack, following the severe recession or depression of the previous years. So it is straightforward to me that a negative outcome in the negotiations or a hard Brexit would definitely have an impact on the Greek economy. There are 2 additional slides here showing the share of total Greek exports of goods and services vis-à-vis international trade with the UK, but all these graphs and many more will be in the study we're going to be publishing in a few days on the potential impact of Brexit on the euro area and the Greek economy. So, with that note, I would like to thank you very much for your attention.